Welcome to the course on non-life insurance. My name is Katrien Antonio and I will be teaching this course. Now, this first video covers credibility theory, a cornerstone of actuarial mathematics that deals with two challenges. On the one hand, credibility theory allows to describe and to model heterogeneous risks. On the other hand, it naturally offers a framework for so-called a posteriori pricing or experience rating. In a posteriori rating or pricing, the reported claim history of a policyholder or contract is taken into account, next to his observable risk factors. As such, an a posteriori pricing scheme complements the a priori pricing techniques that we already discussed earlier on in the course. Now, the lecture sheets used in these videos are based on the book by Professor Michel Denuy and co-authors covering actuarial modeling for claim counts. Another very detailed reference on credibility theory is the book on the left by Buhlmann and Gisler, with the cover shown here on the screen. Now, assume you face the following actuarial challenge. For a given group of insurance contracts or policies, you have to determine a fair price or tariff for each of the involved contracts. Here too, you can rely on either the experience of this particular group of contracts, or you can rely on the experience related or reported on a larger group of related contracts. Credibility offers you a way to balance both resources. And to express this more formally, we introduce the random variable xjt to denote the claim experience on contract J during time period T. J may refer to a single contract, but it may also refer to a group of contracts, depending on the setting under investigation. And T runs over the available time epochs during which claim experience is registered. Now, using this input, the goal is to determine the next year's premium for contract J. That is, we want to predict the random variable xj t plus 1. And a big challenge is to figure out how to combine the individual experience of J with the collective experience that is collected over all the J's in the dataset. One can take two extreme positions in this problem. One can either charge the same premium, x bar, to everyone, and x bar is here the global average over the whole dataset available, or one can charge to group J its own average, xj bar. Both extreme positions have their own drawbacks. X bar only makes sense if the portfolio is super homogeneous. If not, good risks will be charged a premium that is too high and they will leave the company, leaving the portfolio with only the bad risks. But xj bar only makes sense if there is enough experience registered on contract J to have a reliable estimate. With limited experience on contract J or group J, the xj bar estimate will be volatile and inaccurate. As a compromise, a credibility estimator is a weighted average of both extreme positions. Here, zj is the credibility factor. It expresses how credible the experience in cell J is. With J1 equal to 1, cell or contract J gets full credibility, and with zj equal to 0, no credibility is attached to the experience of cell J, and the overall average x bar will be used. As discussed in the videos covering a priori pricing, observable risk factors are used to calculate for each insured a price that accurately reflects the risk the policyholder represents in the portfolio. despite using these a priori rating variables, heterogeneity remains between policyholders belonging to the same tariff cell. Having some history on the policyholder or the contract available, the insurer will reward policyholders that perform better than the average experience in the tariff cell they belong to, and the insurer will penalize risks that perform worse than average. Hence, the premium or tariff should be adjusted based on the individual claims experience of an insured. That is exactly what credibility theory does. And the reasoning behind this mechanism is as follows. The number of claims reported over successive insurance periods has value and reveals the hidden or unobservable features of a policyholder. That is, for example, aggressiveness behind the wheel or swiftness of reflexes, which cannot be measured or expressed in observable features. But the history of reported claims may be a good indicator of such risky behavior. By adjusting the premium of a policyholder based on past individual claims experience, the insurer will restore fairness among policyholders. And through the reward or the penalty of the a posteriori rating, policyholders will pay a premium that is more in line with their actual risk. Now, credibility in actuarial science serves various purposes. First of all, it is a mathematical tool to describe heterogeneous collectives. Second, it provides actuaries with a technique to determine premiums for contracts that belong to a heterogeneous portfolio. Third, it is used when there is limited or irregular claim experience for each contract, but there is ample claim experience for the portfolio or the group of contracts. And last, it is a set of quantitative tools that allows insurers to perform experience rating or a posteriori rating. Historically, actuaries have proposed two different types of credibility mechanisms. On the one hand, the limited fluctuations credibility, and on the other hand, the greatest accuracy credibility framework. Now, with respect to the first one, the limited fluctuations credibility, we refer to the work of Mowbray back in 1914 on the pricing of workers' compensation insurance. This type of credibility can be seen as a mechanism to either assign full or partial credibility to a policyholder's experience. And this experience should be seen as the history of claims reported by the policyholder. When this experience gets full credit, the policy is rated on the basis of its own claim history. When assigning partial credit to this history, a weighted average is used of the past experience on the policy on the one hand and the overall experience on the portfolio on the other hand. The limited fluctuation approach provides simple solutions to this problem, but it suffers from a lack of theoretical justification. And therefore, this stream of work on credibility theory will not be explored in our class. Now, our focus will be with the so-called greatest accuracy credibility, and we will cover the basic principles of this framework. Using an a priori tarification model leads to tariff cells or pricing cells which group policyholders with similar underwriting characteristics. However, as motivated earlier on, some heterogeneity will be left in these cells due to the existence of covariates or features that also influence riskness, but which cannot be captured with observable risk factors. And to express this remaining heterogeneity, we introduce a random risk variable theta. This variable is not observable, it is random, and it captures the unobservable characteristics of the risk insured. And we assume that this random variable follows a certain cumulative distribution function denoted here with f theta. We will estimate this risk variable and its distribution from the available data. To estimate this random risk parameter, we will use a conditional expectation. More specifically, the expected value of theta given the history of claims reported on the policy. Through this construction, the history of the insured will be taken into account in the a posteriori tariff, and we are applying, in fact, some Bayesian thinking in this setting. Now, in the a posteriori rating plan, the insurance premium will be the product of a base premium on the one hand and a credibility coefficient on the other hand. The base premium is obtained via an a priori rating model that takes the current observable rating factors into account. The credibility coefficient is a function of the history of past claims at fault. It is thus an a posteriori correction applied to the base tariff, and we will explain in the next videos how these corrections are calculated. Naturally, in the a priori rating system, there was a balance between the losses observed and the technical a priori premiums charged. If not, the price list would not be an adequate reflection of the costs incurred. But what we see now is that when insurers will reward or penalize policyholders as a correction on the a priori premium, that mechanism is possible, but of course these increases and decreases must balance. That is why we will assume an expected value of 1 for the random risk parameter theta. And as such, the a posteriori corrections will have an average equal to 1. This concludes our first introductory video on the topic of credibility theory.